Welcome to XRP Pro Ledger, and today we have one of those sessions where the price chart looks quiet on the surface, but underneath it, everything that matters for the long-term XRP thesis is moving fast and building momentum in ways that most retail investors are completely missing. XRP is sitting at $1.43, grinding upward throughout the day, holding its position between $1.40 support and $1.50 resistance. And while that range feels frustrating to watch, the data beneath the price action is telling a completely different story from the one the chart appears to be showing. The XRP ETF tracker recorded $7.38 million in inflows today on a day where the price barely moved. Institutions are accumulating at every available price level regardless of daily volatility. A veteran trader just went on record saying there is absolutely nothing stopping $1,000 to $2,000 per XRP in a repricing event. David Schwartz just dropped one of the most quietly significant NDA statements in Ripple's history. And the Bull Street app just tweeted they are about to flip the switch. The price is steady, the infrastructure is anything but. Let us start with the technical picture because the chart set up at $1.43 is more interesting than the flat daily candle suggests, and understanding the structure helps you understand why the institutional money showing up in the ETF data is positioning right now rather than waiting for a confirmed breakout. The one-week chart shows XRP locked in a clear channel between $1.40 and $1.50, with the price grinding higher throughout today's session in the kind of slow, methodical upward movement that technical analysts associate with accumulation rather than momentum-driven buying. A close above $1.50 that holds is the signal the market needs to confirm that the breakout is real and not a wick. Above that, $1.55 is the next level, and a confirmed hold above $1.55 targets $1.80 as the next significant resistance zone. The symmetrical triangle pattern that analysts are tracking on XRP right now signals a potential 35% swing from the $1.45 level, meaning the resolution of this compression could target $1.80 on the upside or test $1.38 on the downside. Personally, the weight of the institutional evidence points toward the upside resolution. $1.30 looks like the structural floor, and the market right now looks fundamentally too strong for a deep breakdown before the breakout. The Clarity Act situation deserves a direct and honest assessment because the delay narrative has been creating unnecessary anxiety in the retail market, and getting the context right changes how you should be thinking about the legislative timeline. The U.S. Crypto Clarity Act is facing a late April deadline, and a delay likely pushes passage beyond the original timeline into a more complicated political calendar. That is a real risk, and it is worth acknowledging clearly. But here is the context that makes the delay less consequential for XRP specifically than it is for the broader crypto market. More than 120 organizations from across the digital asset ecosystem, including Ripple, Hedera, and dozens of major crypto infrastructure companies have formally urged the Senate Banking Committee to move forward with the markup on market structure legislation. That level of coordinated, organized institutional advocacy is the kind of pressure that moves legislative timelines. The politicians arguing with banks about stablecoin yields are not blocking XRP's regulatory future. XRP already has its legal clarity from the courts. The Clarity Act matters for the broader ecosystem. XRP is already cleared to move. The daily DeFi exploit situation is creating a dynamic that deserves serious attention from every XRP holder who has been considering wrapping their XRP or chasing DeFi yields, because the risk profile of those strategies is getting worse with every passing week. Tipa Capital just identified unusual on-chain activity involving yield basis contracts. An attacker deployed a custom contract to drain assets from 3 vaults, extracting $1.25 million in wrapped Bitcoin in a single exploit. This keeps happening. Every few days, there is a new DeFi exploit, a new bridge hack, a new protocol drain, and every time it happens, the argument for XRP's native on-chain security architecture, the 13-year zero protocol level exploit track record, gets stronger by contrast. Wrapping XRP to chase DeFi yields introduces exactly the kind of bridge risk that Ripple's CTO David Schwartz has publicly warned about. The safer yield generation option is coming through the native XRPL lending protocols being built through XLS65 and XLS66. Until those protocols are live, the DeFi yield-chasing game is a risk that the daily exploit headline stream is proving is not worth taking. Now let us talk about David Schwartz's NDA statement, because what he said publicly is one of those moments where reading between the lines carefully tells you more than the surface-level message. Schwartz said on camera that there are lots of NDAs around agreements at Ripple, that 99% of what you see is what you get, that there are no major secrets going on for years, and that if your investment is based on the belief that there is some big secret plan about to be revealed, you are probably fooling yourself. On the surface, that sounds like a deflation of the conspiracy theories that circulate in the XRP community. But here's what Schwartz also said: he cannot tell you what is going on behind closed doors because of the NDAs. He acknowledged he has a pretty good idea of what is happening at Ripple and the XRPL Foundation, and he carefully scoped his statement to what he knows, leaving open the possibility that things are happening in places he does not have visibility into. He did not say there are no NDAs. He said the NDAs are not earth-shattering on their own. The most significant NDA in the XRP ecosystem, the one between Ripple and BlackRock, was not addressed, and that silence is louder than anything he said. The BlackRock and Ripple NDA thesis deserves serious analytical engagement rather than dismissal, because the circumstantial evidence for a significant relationship between these two organizations is not based on rumors. It is based on documented institutional behavior that points in the same direction consistently. BlackRock has been building tokenization infrastructure at scale. Ripple Prime is the first crypto firm with a global multi-asset prime broker capable of handling institutional clearing and custody for tokenized assets. The XRPL is the only major blockchain with a 13-year zero-exploit track record that meets the security standards institutional compliance teams require for large-scale asset tokenization. Larry Fink has been describing a unified digital ledger on Davos stages for years, and the technical specifications he describes map almost word for word onto XRPL's existing architecture. The FedNow expansion to 1,700 institutions, Ripple's money transmitter license network, and the Ripple National Trust Bank charter conditional approval all point toward a domestic U.S. payment infrastructure integration that would be the natural commercial deployment of whatever Ripple and BlackRock are building together. Schwartz did not deny the BlackRock NDA exists. He just said the NDAs he knows about are not earth-shattering on their own. The one he cannot talk about may be a different category entirely. The Bull Street app tweeting that they are about to flip the switch is the kind of infrastructure deployment announcement that retail investors underweight because it sounds like a marketing post, but actually represents something structurally significant when you understand what it means for XRP's on-chain activity and demand. Bull Street is one of multiple platforms and applications building on XRP infrastructure that are reaching operational readiness in the same window. When they say they are about to flip the switch, they are describing the moment when a new source of on-chain XRP demand goes live, a new application, a new user base, a new transaction flow that did not exist before. This is not a one-time event. It is the first of what is going to be a sustained series of switch-flipping moments as the infrastructure that has been built around XRP over the past several years comes online in sequence. Each new deployment is additive organic demand. Each new platform going live is a new source of XRP transactions. And the compounding effect of dozens of these deployments happening in the same window is what the utility run thesis is built on, not a single catalyst, but a cascade of infrastructure activations that builds organic demand faster than the price can track it in real time. The Ripple custody development is the institutional adoption layer that most retail XRP analysts are not giving enough weight because it operates behind the scenes rather than in the consumer-facing market. Ripple's custody solution is being positioned as the governance layer that everything else runs on. Without secure, compliant custody infrastructure, digital asset strategies including payments, tokenization, and staking cannot scale to institutional deployment. What Ripple has built is a custody solution that reduces complexity rather than adding to it, accelerates deployment timelines, supports regulatory requirements, and grows as use cases expand. For the institutions that are evaluating XRP for tokenization deployments and the DTCC wanting to bring trillions of dollars of value on-chain, is the scale reference here. The availability of a Ripple native custody solution that integrates with the same infrastructure they are using for settlement removes one of the most significant friction points in the institutional adoption process. You do not have to manage separate custody, settlement, treasury, and prime brokerage relationships when Ripple provides all of them under one roof. The repricing event thesis is the conversation that serious long-term XRP analysts are having, and that the retail market is not yet equipped to fully process, but it deserves to be laid out clearly because the mathematics of it are compelling and the institutional logic behind it is sound. The DTCC wants to bring trillions of dollars of value on-chain. The global tokenized asset market is projected to be measured in the tens of trillions by the end of this decade. When you need to move trillions of dollars of tokenized value through a settlement layer in real time, the settlement asset needs to have a market cap that is proportional to the value flows it is facilitating. XRP at $1.44 simply does not have the market cap to serve as the settlement layer for trillions in daily tokenized asset transactions without creating massive price impact on every transaction. A repricing event, a deliberate institutional decision to establish XRP at a price level commensurate with the settlement demands that will be placed on it, is not speculation. It is the logical conclusion of the tokenization infrastructure story, and it is why veteran traders are on record saying there is absolutely nothing stopping $1,000 to $2,000 per XRP when that repricing happens. The alt-season mechanics that are developing right now are different from every previous crypto cycle in a way that XRP holders specifically need to understand, because the rotation dynamic this time is not going to follow the historical pattern of Bitcoin pumping and then capital rotating into speculative altcoins. What is developing is a conversion of the traditional alt season into a utility run, a sustained period of price appreciation driven not by retail FOMO rotating from Bitcoin, but by genuine institutional utility demands flowing through XRP infrastructure at scale. Tokenization picking up significant momentum in the second half of 2026, Bitwise's Matt Hogan identifying XRP as one of the primary beneficiaries of the next market cycle, and the integration wave happening across Rakuten, Bull Street, Exodus, Binance, and dozens of other platforms simultaneously. These are the building blocks of a utility run that does not have the boom and bust characteristics of a speculative cycle, because the demand driving it is structural rather than sentiment driven. Bitcoin continuing to push toward $100,000 in one final move before it tops is the macro setup that pulls the entire market up and gives XRP the price momentum it needs to break above $1.50 and trigger the cascade of FOMO that follows a confirmed breakout. The complete picture today is one of quiet, methodical, relentless institutional positioning happening beneath a price chart that looks deceptively boring. XRP at $1.43 with $7.38 million in ETF inflows on a flat price day. David Schwartz carefully scoping an NDA statement that leaves the BlackRock relationship explicitly unaddressed. Bull Street about to flip a switch. The Clarity Act facing delays that do not affect XRP's already established legal clarity. The symmetrical triangle compressing toward a resolution that targets $1.80 on a confirmed break above $1.55. The DTCC tokenization scale creating the mathematical inevitability of a repricing event, and a veteran trader on record saying there is absolutely nothing stopping 4-digit XRP when that repricing coincides with tokenization at scale. The price is steady. The infrastructure is anything but steady. It is moving fast, building quietly, and getting closer to the moment where everything that has been assembled in the background becomes visible in the price simultaneously. Stay patient. The switch is about to get flipped. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.